Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne with David Ingles.
Good morning. Let's get to your top stories today. Chinese tech stocks will be in focus at the open this hour after Temu's parent PDD falling the most on record after the company warning of slowing sales ahead. Now, broadly speaking, stocks across the region are under pressure after big U.S. tech drags on Wall Street ahead of Nvidia earnings. We're also looking at Brent crude and energy prices surging above $81 following a Libyan export ban. And Canada announcing tariffs on China-made EVs, aluminum, and also steel, prompting a warning from Beijing on economic and trade ties.
All right, there's a few jitters in these markets here right now. You take a look at what the Wall Street session did, and really it was the Mag 7 and really tech that led to that drag when it comes to U.S. markets. U.S. futures are still in negative territory. We're feeling that here in the Asia Pacific, and we're watching as markets like Taiwan open up. The semiconductor space, certainly very much something we're watching, given what we saw with the SOX index yesterday. There's some nerves leading up to this Nvidia earnings on Wednesday in the U.S., Dave. So that certainly is what is wobbling right now. And really, we're seeing a little bit, not much movement in treasuries, though. And we're watching Brent markets, as Dave mentioned there, given some of the threats to supply in Libya. There's also geopolitical tensions. We're seeing Brent still around that $81 level there. Shanghai crude is also following through. We're seeing upside about 2.5% or more this morning. Flip the boards. The dollar is flat this morning. It's not so much that much of a FX story, but really what we've been hearing in earnings, whether it's Nvidia, whether it's PDD. We're also watching the Asia semiconductor stocks as well, just given what we saw with the chip stocks in the U.S. TSMC just coming online. We're slightly seeing some downside there in Taipei. But at Ventus, Disco, seeing some pretty sharp declines when it comes to some of these Japanese chip stocks this morning. You take a look at how the approach to the open is looking like as well. We talked about PDD, that plunge of 29% in one day. Nasdaq Gold Dragon did this, but that PDD plunge definitely sent their rivals like Alibaba and JD lower overnight as well. So we're watching that in the Hong Kong Open today, whether we see some sort of follow through. But basically, PDD warning about the revenue growth will inevitably dwindle. That was the sort of the warning about the consumer that is weighing on this market here today, Dave.
Yeah, I'm looking at initial pricing right now, and I should note this could change in the next few minutes or so, but Alibaba is now being quoted below $80 right now, and we close at 83, 84. So that's a 5% move, give or take. We'll see how this progresses, and of course that goes into what we're tracking here today. I'll use the past tense, bullish break. We were on the verge of that on the Hang Seng China Index, and I'm guessing some of the drag we'll be getting from the big tech today we'll push that back a couple of more days. We did get a massive move yesterday, just keep in mind, in Hong Kong property on the back of these sort of Fed rate cut conversations. We might be giving that back as well. In terms of data coming through today, trade numbers from Hong Kong later today, industrial profit numbers coming out of China in 27 minutes from now. And speaking of earnings, Nongfu Spring, some of the other companies set to report later today. Right, now in terms of sectors to watch, we talked about oil up nearly 8% on Brent over the last 3 or 4 sessions. We're looking at energy, we're looking at Shanghai crude contracts on the back of the conversations and tariffs from Canada on things like EV, steel, and aluminum. Those sectors are to watch, of course, and of course e-commerce for very obvious reasons, given the warning and the warning signs and all these downgrades coming through on the price targets for PDD. As Yvonne is pointing out, a 30% drop overnight, and we are likely to see that going into this Tuesday session, Vaughn.
All right, let's get more on those numbers and bring in our tech reporter, Annabelle Jewelers. Annabelle, it's a dramatic drop, the most on record on the stock. What do you think was what worried the market the most, and what we heard from the PDD head?
It was really the repeated warnings about the outlook. I mean, you think about the competitive environment within China. You've already got these established players, you've got the new entrants in this space, and all of them are really trying to reach consumers and get them to dip into their wallets at a time when they've already been cautious for a variety of economic reasons. And so the co-founder, Chen Lei, stressing that the current trajectory of the company isn't sustainable and saying that multiple times really made investors very nervous. You take a look here at that share price reaction. As you say, that huge drop that we saw, the biggest on record. But think about the context of PDD as well, because it has seen quite a tremendous run up in its share price. At one point, actually, even overtaking Alibaba in market cap. You saw its founder becoming the wealthiest man in China as well for a brief around 2-week stint. But still, he did do it. And really, that optimism around PDD and its Temu platform in particular, that now seems to have changed quite substantially. As I said, the co-founder Chen Lei saying that competition, it's here to stay. It's only going to become more intense, not only domestically, but also internationally. You've got other players like Walmart, Amazon, they're trying to keep pace as well.
And Bill, what is there a regulatory angle too that we need to sort of highlight as we try and form, I don't know, an opinion of where this goes longer term?
Certainly, it really plays into it. You've got all of these concerns, particularly in the EU, around the rise of these low-cost players and the influence that they have on the competitive market there. What makes Temu a really standalone or stand-apart model is that it connects factories directly with customers, and it cuts out middlemen in the process, and as a result it can offer lower prices. And so that has been a real concern, particularly in the EU, where they've got a duty-free threshold for online purchase of around 150 euros, around 160 US dollars. That's what's now possibly being reviewed, and the main focus of that is these Chinese e-commerce giants like Temu, AliExpress, Shein. That's according to people that have been familiar with the matter, but certainly something that could also weigh on PDD's outlook. At the same time that you've also got other players that are trying to catch up to its model. As I said, it's got that distinctive model, and we've actually seen Amazon, for instance, looking to offer something similar on its platform as well. So you've not only got the regulatory risk, you've got also that risk that the more established players also start to offer similar versions.
And I think leading up to some of the earnings from some of the tech giants we got last week or so, Belle, was that there was a theme that was emerging that the incumbents were fighting back, the likes of Alibaba, JD, in this whole e-commerce fight. Is this sort of what we're hearing now, that the thesis is really changing around some of these e-commerce names?
Yes, certainly. I mean, you were speaking, for instance, last week saying that can the elephants dance again? But is it Alibaba? Is it Tencent that once again can be more competitive? Certainly, they've really made that effort to streamline their operations, to cut down on costs, to refocus on their core competencies. And that really starts to be paying off. Perhaps didn't show up entirely in the latest Alibaba numbers, but still, it does seem like they are turning more positive once again. Still, though, actually, if you talk to our Bloomberg Intelligence team, they're saying that PDD can still manage 20% revenue growth on the year going into 2027. That's their thesis, if they can continue to add to their e-market, or rather e-commerce market share via the Temu app outside of mainland China. So they're still optimistic on them being able to attract more merchants, more customers, even if they need to see margin growth in the nearer term. And also on their expanding global ecosystems. That's another positive factor. So Bloomberg Intelligence is more popular, or rather more positive on the outlook, but still, of course, it does seem that the investor sentiment is shifting slightly around the more established players.
Belle, thank you so much. Belle, Annabelle Toulers, our tech reporter in Sydney. Yes, and as Belle was pointing out, while the outlook longer term might be somewhat still rosy, we need to deal short term with likely the market crunch we'll see today from, of course, the likes in the bottom of your screens. We are likely going to get a drop at the open, a sharp drop at the open in the likes of Alibaba and also JD.com. Right, from one top story to another, Canadian Prime Minister Justin Trudeau has announced new tariffs on Chinese-made EVs, aluminum, and also steel, joining Western allies in taking steps to protect domestic manufacturers.
We will be introducing a 100% tariff on Chinese-made electric vehicles and a 25% tariff on Chinese steel and aluminum. But actors like China have chosen to give themselves an unfair advantage in the global marketplace.
For more details on the story, our China correspondent Min Min Lo is here with us. Yeah, well, what do we know?
Yeah, well, 100% tariffs on EVs, 25% on steel. Does that sound familiar? I feel like we just talked about that a couple months ago. It's similar to what the Biden administration has announced on Chinese products. And not surprising here, because Canada is an export-driven economy. It sells 3/4 of its exports to the U.S., so it's aligning very closely to the U.S. here. The Canadian tariffs will target not just fully electric vehicles, but also some hybrids, as well as trucks, buses, delivery vans, pretty much closing off the entire entire sector to Chinese producers who still currently don't have a foothold in Canada. So this is a preemptive move here. And the Canadian government is also looking to restrict incentives for EVs to those that are made in countries that have a free trade agreement with Canada. So obviously China is not on that list, but Canada does have a free trade agreement with Mexico and with the US. So could Mexico be that final gateway for Chinese producers to enter North America? That's a big question. BYD is planning to build a plant there. They said they're not planning to export from Mexico. And you saw that quote there, the finance minister of Canada was saying that Chinese overcapacity is driven by the abysmal record on environmental and labor standards, saying that Canada will not allow a policy where that is built upon abuses of Chinese worker and pollution on China. But obviously, China has hit back, saying that its capacity is driven by domestic technological innovation and domestic competition here.
Yeah, and U.S. National Security Advisor Jake Sullivan, I mean, after speaking with Trudeau, he's heading to Beijing today. What's on the agenda there? Yeah, well, obviously these tariffs, the investment restrictions, the unilateral sanctions are going to be on the agenda. China has been very angered by U.S. actions to rally its allies to take these concerted actions to limit or curtail China's rise as Beijing sees it. And of course, there is Taiwan, China's red line. China's foreign ministry said that this is something that they want to raise, especially after the U.S. has been repeatedly provoking China when it comes to Taiwan by, increasing military backing, repeatedly saying that they are going to come into Taiwan's defense in the event of a Chinese attack. For Jake Sullivan, his agenda will likely also include raising the issue of Chinese backing for Russia amid the Ukraine war. U.S. has been accusing China of selling those dual-use equipment that could aid Russia in the battlefield and soften the impact of those sanctions on Russia. But again, this is Jake Sullivan's likely to be his last trip before the U.S. elections. So U.S. officials have downplayed any sort of concrete breakthroughs that can come out of this because there's so much uncertainty over whether there will be a change of administration in November. And U.S. officials have said that he will not be speaking on behalf of the next administration, that this is just a part of a series of regular meetings between the two sides to maintain communication, to keep up that pledge that President Xi and Biden made at the end of last year. All right, Min. Thank you, Min Lo there, our China correspondent with the latest when it comes to EV tariffs in Canada. And still ahead, we're talking all things fixed income with another Fed official signaling that the central bank is on track for rate cuts. We have analysis from BEA Union Investment. Coming up next, we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show.
Well, to my mind, we've been on this path of ready to adjust policy rates for several months. We just needed to get a little more confidence that inflation was truly on its path to 2%. And I wanted to see the labor market come into balance, but I think that's completely happened. And the risks to our goals are now balanced, and the time to adjust policy is upon us.
And that was the San Francisco Fed President Mary Daly backing, of course, Jay Powell's outlook and calls here for coming rate cuts. Let's talk about the implications here in fixed income. Is everything priced in at this point? Pheona Tsang is here with us on set, fixed income CIO at BEA Union Investment. Good morning and nice to see you. I mean, if we could start on the Fed and this coming rate cut, and let's hope it comes, has been, I think, well flagged and well watched by markets. And I'm wondering, when you look at the Treasury curve, do you think, is there still value right now in the Treasury curve, or has all of these things been priced in?
I think I would like to look at it from a more medium-term view.
Okay.
What is the inflation expectation and the real rate components. So now we have a core inflation in the mid 2 to high 2%.
Yep.
Right? And the real rate, if you look at the historical, it will be around 0 to 0.5%. So I would think that for this whole rate normalization cycle for the next 2 years, the terminal rate should be around 3 to low 3%. Then it comes to the Treasury, right?
Yeah.
When we have a terminal rate like this, the Treasury for the 2 year can be 3 to low 3, and the 10 year can be mid 3 to high 3, right? So usually before the rate cut or when we have the rate cut, then the curve will steepen. So we have been doing that, right, for the last month, and it has been normalizing. So we will assume still more steepening to come. So I guess people will look at usually how many rate cuts we have in September and then this year. I always think that is better to look at it in a medium-term view. And from the point of investor, that is a time to invest in bond, which you still have a high yield carry, and which is we still have the rate normalization to come.
So you said this whole debate about whether it's 25, 50 basis points, don't think about that at all? How important is it to actually talk about the pace of these cuts?
Yeah, I think the guess is Powell have in the Jackson Hole speech have confirmed that September will be the start of the easing cycle, and he shift the focus from inflation to labor market. So then the labor market data is very important, and we'll have more signal from the number to be announced on 6th of September. Right. And that will determine whether a 25 or 50 basis point for September. But I think the market had also priced in a 30% chance of a 50 basis point in September.
Yeah.
So it won't be a big surprise on either one. So.
If they give us that.
Yeah.
Okay.
Yeah.
Well, I guess let me take it back then to the medium term, right? You mentioned if neutral is at 3, based on real rate average, that's 10 cuts from now, right? About 10 cuts. Markets have priced about 6 or 7. So my question is, do we go back to 3, given that inflation has come back and I guess the historical average is somewhat pulled lower because we didn't have inflation for 15 years?
So the assumption I just mentioned is around 2.5 and high 2, right?
Okay.
So actually, there's quite, I think, it's quite reasonable. It's not even to the target of 2%.
Okay.
So I think that is still quite realistic in terms of the about 200 basis point rate cuts for the next 2 years.
Okay. Just given the Fed pricing, and we've seen basically spreads in Asia bonds, dollar bonds, tighten the last few weeks or so. Where are the best places to really lock in these higher yields now?
Yeah, I think there are actually still places that we can look at in Asian bond because there is still quite divergent in terms of credit spread within different sector and rating. So you see quite a lot of spread tightening, maybe in single A sector, but in the triple B sector, there are still quite wide opportunity in terms of spread, especially some of the issuer that we issued this year, they come in wide. So these are the pockets of opportunities that we can tap into.
Yeah. So I notice you're also constructive and positive still on Chinese tech, e-commerce, and certainly there is yield on the table. And I'm wondering, not sure if you saw the news overnight, PDD, the stock dropped 30%, and questions now whether e-commerce in China is as healthy as we were thinking 2 days ago. Does that change your call on credit in Chinese tech?
Because I think it's quite different if you look at it from a credit fixed income investor point of view.
Okay.
Because we don't really just look at growth. What is most important is their leverage ratio. And we see most of these TMT companies have cash that is actually more than the debt in a very healthy position.
Okay.
So as long as their financial ratios stay in that way, then we are still very constructive. Yeah.
And other sectors that you look at across Asia that you think are still opportunities?
I think Asian high yield is still the one, also have opportunities. If we look at Asian high yield, the average rating is double B compared with the US single B. And we actually have over 70% of the high yields in double B rating compared with the 50% in the US. And we have a record no default rate. If you take out Chinese property, is below 1%, lower than the 2% in the US. Yeah, and from actually now it's very diversified in Asian high yield. We have the largest countries is actually India, and India you have a lot of industry to choose from, whether it's renewable energy or some infrastructure like airports and toll road. and as well as some non-bank financials. So, and the most important thing is Asia did not have the intense rate hike cycle as in the developed markets because of their low inflation. So they can refinance in their local bond market and bank loan markets, which enable them to call back early tender many of their US dollar bonds and make the supply very tight. And so we have a much more resilient market compared if we have a macro volatility just like what we've seen in the last month. We actually see investors come in to buy, and they even tap into new issue from the issuer directly so that they can lock in some good opportunity to buy when you have the lower mark-to-market in prices.
Pheona, thank you. Pheona Tsang there, fixed income CIO at BEA Union Investment. As we expected, we are seeing quite a dramatic movement when it comes to some of these tech stocks here today after that warning from PDD and their earnings. And there you go, Alibaba and JD both falling some 4% or more. Kuaishou's down a little bit less, but we're still talking about 1% losses there. So we'll count you down to that open coming up. This is what the pre-market on Hong Kong is looking like here today. Obviously, HS Tech is going to be in a bit of trouble here this morning, and we're watching very closely what's been going on with CGBs. Is the PBOC losing a little bit of traction now in their way to restrain some of these bond bulls out there? 216 for your Chinese 10-year, but yeah, the Hang Seng's down about 0.75%. This is Bloomberg.
Okay, the big story, of course, is in e-commerce and in tech, and some of the changes here on the back of the PDD story.
Yeah, we've seen actually several downgrades on the stock already, and the ADRs cut to neutral at Citi. Alicia Yap and her team saying, look, the firm's struggling to reconcile whether what's really leading to this cautious tone. Is it intensified competition? Is it a shift of consumer patterns or anything else? Sunny Optical raised a buy at HSBC, and Jim Mao Property Services also raised to a buy there at the bank as well. Of course, stocks in focus are watching out for earnings.
Yes, Antisports is coming out later today. PetroChina reported yesterday in Trip.com a couple of hours back, about 2 hours back, and actually quite a big beat there as far as Trip.com is concerned. And as you can see, that is being reflected in the stock price in the early goings. We're called about 9 Hong Kong dollars to the upside here. Going into the open today, we're looking at tech and really circling back to the e-commerce space where the HS Tech Index, there we go, on your screens as expected, really feeling the brunt of that warning out of the company, PDD, overnight. The opening bell, 3 minutes away. This is the China Show.
Welcome back. You're watching the China Show. Might be a bit dicey here today if you take a look at what the tech sector is doing, not just in Hong Kong, but really globally speaking. Nvidia earnings are on tap on Wednesday in the U.S., so there's a bit of, I guess, nerves letting into that. A lot on whether they can actually deliver once again, but also when you take a look at when it comes to HS Tech and its PDD, that story that overnight that really is sending some shockwaves across the e-commerce space in particular. So Alibaba, JD seeing already some steep declines in the pre-market, Dave.
Yeah, and it didn't last very long. Well, at least the reign of the billionaire founder at the top of China's rich list because of the 30% drop. I think, what, 2 weeks?
Yeah.
2 weeks at the top. The other thing that didn't last long was that positive breakout out of Hong Kong yesterday where the Hang Seng China Index actually was poised to, well, before today, poised to actually open above the 100 moving average. The Hang Seng is there. Let's see if that holds, of course, as support today. In terms of data that comes out, should be out any time now. In fact, you have industrial numbers, industrial profits specifically, coming out today, and also Hong Kong trade numbers. In terms of earnings, we did get from Trip.com. We are still yet to get Antisports, really another snapshot of consumer. The health of the consumer there as well. And there we go. Industrial profits numbers are now up 3.6%. That's year on year, year to date. Okay, let me just rephrase that. It's simpler. So this is a Jan to July number, up about 4%. Okay, so July is up 4% year on year. January to July is down about 3.6. Okay, you have to do the average there. Okay. The open in Hong Kong is looking like this. And of course, there within that space, we're looking at tech, HSEC down 1.4, only down 1.1 right now. So we are pairing some of the early pressure. Alibaba, bottom of your screens. Certainly within tech, you focus in on e-commerce like Kuaishou, Alibaba, JD.com. A lot of these companies that are, sort of have similar overlap with Pinduoduo. And there you go. JD.com down about 4% in the early goings. Very, very briefly, movers, of course, to tell you about. So we had news, of course, out of Canada and tariffs there. So we're looking at some of these EV plays, Trip.com also, and as you can see, going against the grain. And this is the good news story within the Chinese earnings story, this big beat out of Trip.com, as you can see, bottom of your screens, 725. The estimates were almost a full 2 renminbi per ADS. Lower than what it come up with.
Yep, and certainly the PDD story raises a lot of questions on really where this consumption story goes. Are we really seeing signs of recovery? Doesn't seem like it, just given what we've seen hearing from the earnings so far. Let's get the economist perspective and bring in Grace Ng, senior China economist at JPMorgan. The consumption story still seems to be the same. That we're still talking about dwindling, sort of what people are looking at in terms of the spending and the like here. GDP forecasts for most of you and your peers have basically been very close to, not even there, close to the 5% target. You recently had to revise yours as well.
Yeah, indeed. We have seen a pretty volatile number this year. You had a good first quarter, but that quickly began to lose momentum going into second quarter, which is quite similar to what we saw last year. What is different is that this year the government actually came in to recognize the weakness in momentum and started to come through with policy support from about May onwards. The problem is that for some of these measures, either they are seen as not enough, such as that for the housing sector, or the feed through to the real economy is seen to be quite slow and modest, such as the support for infra. We saw infrastructure investment weakening to year low by July at 2% growth. And then on the consumption side, even though policy is recommending further support for consumption, if you look at household income, expectation and confidence, it still remains on the soft side. I guess the good news is that for July, you did see a little bit of pickup in retail sales, but the overall momentum remains somewhat soft. So as a result, we have been revising our forecast. Our latest growth forecast for the year as a whole is 4.6%. So that is somewhat below the government's growth target of 5%. Even though we do expect the policy support measures to gradually come through to the economy, that's probably more of a late third quarter or fourth quarter story. So that's probably not enough to bring back growth momentum to, say, 5%.
Yeah, I think you're not alone. I mean, most of your other peers also have a forecast of below 5%. What kind of drag do you still expect from the property sector overall in terms of growth? And, what is the best case scenario then if some of these measures that they're putting in place start to take effect?
Yeah. To be very fair, some of the demand side easing measures have been pretty notable so far, especially in through the course of this year. The problem is that household sentiments in terms of their income outlook, in terms of their job stability, remain somewhat on the soft side, and people still have yet to see signs of bottoming and recovery in prices as a whole. So they are kind of holding back in terms of potential home buyers. The government has come up with a pretty interesting program to push for destocking or a reduced inventory in the market by encouraging local governments, local SOEs to take over the unsold finished stocks so as to help to clear the market. And the PBOC came up with a 300 billion re-lending facility to help to support the funding of that. The problem is that the progress on that front is still very, very slow, partly because of the diverging incentives from different players. So the developers are not very keen to cut prices, but then the local SOEs are concerned about rental return and return on their projects. So in that regard, there has still to be more push from the policy side, especially from the central government, probably with a more coordinated central government-led program going forward.
Yeah, we've been crunching the numbers at Bloomberg about how budget spending has been, and basically we've seen land sales see a record fall. Does the government need to then raise that budget deficit in order to borrow more?
Yeah, that is not in our baseline forecast at this moment. What we are seeing is that if you look at so far this year, the fiscal support has been laid out quite clearly at the MPC, but the progress has been rather slow, especially if you look at, say, the speed of special local government bond issuance. That's significantly behind the regular pattern. And that partly reflects concerns such as the lack of viable investment projects on the ground. So in that regard, what we have seen is that the central government has been pushing for acceleration in the issuance of special local government bonds, which has been happening. And then with widening in the usage of the proceeds from these funds. So support of equipment upgrades, support of consumption, subsidies, and even some proposal to help with the destocking in the housing sector. So still, we see the room going forward to better and more efficiently utilize the fiscal room that has been planned, but that has not been implemented so far.
Is the gradualist approach working?
So far, it's gradually working, but in a very somewhat slower than expected pace, which is why our forecast is below the government's around 5% target, which basically means that if they are really very keen to see growth at around 5%, then you probably need to see some further policy kick-up. But at the same time, I think there is the concern of you need to have more room, potentially more room for policy support going into 2025, given the still very much uncertain geopolitical outlook, trade policies, and so on. So in that sense, from the government's perspective, they probably also need to consider not just for 2024, but the room for 2025.
Yeah, I was about to say, I mean, the other side there is there actually merit to focus on high-quality growth and not simply address some of the short-term problems because of everything else that's going on, for example? And it's not as if the economy's crashing.
Exactly. So when we talk about high-quality growth, there are various ways of interpreting that. I think so far in terms of what the policies that we have seen is to focus on core technology, industry upgrade, green economy, AI, big data, and so on, those strategic new industries that typically focus on the manufacturing side, industry side of things, and enhancing China's production capacity. We have seen that in the macro numbers. We have seen that in the industry data. I guess the concern here is more like when you talk about more sustained high-quality growth, what about the other side of the picture, the consumers, the household income side of things, the private confidence side of things? That is the area where we are still seeing pretty much kind of a lagging behind in terms of growth momentum, in addition to the still struggling housing sector. So that's where we are still thinking that policy needs to step up further.
Also, when it comes to the bond market, I'm just wondering, I mean, the weaker economy is why we're seeing this bond rally almost show exuberance in some ways. Do you think what the PBOC is doing, are they losing traction to trying to kind of restrain what these bond bulls are really kind of betting on right now? Yeah, I think that's a very interesting issue right now. I think when we kind of talk to investors about investing in China, domestically and internationally, it seems that, the CGB market is one area that there is consensus that that is still interested. There's still a lot of interest. But that's basically reflecting the macro trend of still rather softer than expected growth, ongoing concern about lack of pricing power, as well as the need for the macro policy to continue, especially on monetary policy front, to continue to ease interest rate. In a way, the central bank is getting somewhat concerned in that the market might have run ahead of itself. And it is concerned about potential financial risk down the road if
interest rate will begin to come back. They kind of keep to refer to what happened in the U.S. First quarter last year in terms of the regional bank crisis and what that might happen if there is too much concentration of market focus on the Treasury, especially on the long end.
Well, speaking of that, there's a story out on the Bloomberg today, and one call is that when the Fed starts cutting rates, that rate differential shrinks, and all this money that Chinese corporates have parked outside in higher yielding assets suddenly comes back into China and drives the currency stronger. Is that a possibility, do you think?
There is always the investor interest on that front, given how much we have seen the private sector, especially the corporate sector, hoarding U.S. dollars in the past 2 years or so. And our strategists are seeing some pretty meaningful amount of excessive U.S. dollar holding by the corporate sector. I guess the issue, though, is that, firstly, it depends on how much the Fed is going to cut rate, and the rate differential is still has yet to meaningfully narrow from here. The other is that there is still forward-looking concern about, again, geopolitical risk, trade policy concerns, which might pose some medium-term drag on the CNY going forward. So I guess the overall situation is not as clear, and therefore corporates still seem to be quite cautious in how they will allocate their assets in yuan asset or U.S. dollar assets.
Grace, it's nice to see you.
Yeah.
Thank you.
Grace Tsang there, senior China economist at JPMorgan. 12 minutes into the session, and we're looking at declines across these cash markets. More on the gyrations in this equity market just ahead. This is Bloomberg. All right, welcome back to the China Show. Some good news. Trip.com shares are on the up, as you can see, up 5%, reporting earnings a couple of hours back here. Adjusted earnings for the second quarter per ADS, as you can see, beating estimates here. Let's bring in Angela Han Lee, our senior research analyst at Bloomberg Intelligence, for a closer look at what were the major drivers.
Yes.
For the company.
I think it's still all about the Chinese traveling outside, traveling abroad, because domestically, I think people are still traveling, but the per head spending is still kind of pressured. But it looks like people are still willing to get visas and travel to outside. So that's the one driving up the whole consumption. So it looks like, as they shared during the earnings call, is that the GMV per traveler on the platform was actually same as last year, while we are all concerned about the consumption downgrades in China.
Yeah.
So I think it's actually a very different number from what we expected before.
Yeah, I mean, these numbers basically defy this whole kind of consumption downgrade story in some ways. How are these Chinese travelers affording these trips then?
So it looks like when they travel inside China, they try to go to cheaper destinations, like they're going to Chengdu and other places. But when they go to overseas, maybe their budget is a bit better. And it looks it's like if you check out the numbers about the revenue growth by segment, the ticketing was only up by 1% year on year, while the accommodation was up much more than that. So that means probably the air flights are becoming less expensive now. So people are allocating more budgets for accommodations like hotels when they go to outside. So I think this type of a mix is helping consumers a bit because they can spend less money on flights.
Okay, yeah. You save on
that always helps.
Accommodation, right? Any insights on in terms of overseas travel?
Yeah, I think it looks like people are still also willing to go to China because the company has been highlighting that China inbound tourism was also going up pretty well. But at least I think still the major driver from our perspective is Chinese outbound tourism. They said that the flights was recovering to 80% of pre-pandemic levels already, while the ticket prices are still elevated compared to pre-pandemic levels. So I think it's still expensive, but people are still willing to go outside, which sounds pretty good, while our restaurants are still suffering. So maybe they want to eat less, but they still want to go out and learn something new. Yeah.
Eat less, fly more.
Yeah.
That's the takeaway.
So it's pray love now. It's only pray love, right?
Angela, thank you. Angela Han Lee there, our Bloomberg Intelligence senior research analyst for gaming and hospitality. Some other big corporate stories were falling out of China today. IBM is said to be shutting down a Harvard research team in China, in part due to geopolitical tensions between the world's two largest economies. place. A source says the team focuses on servers and storage, and the cuts will affect less than 1,000 employees. We're told the job functions will be relocated to other countries, including India. In Taiwanese dumpling chain Din Tai Fung is closing over a dozen stores in mainland China amid slowing consumer spending. Cities affected include Beijing, Tianjin, and Xi'an. The firm says the decision was in part due to the expiration of its business license. The Chinese market has seen a price war among restaurants to lure increasingly frugal consumers. And Nike's Jordan brand says it's bringing several of its top sponsored NBA stars on a tour of China and a new push into a key growth market. Luka, I always say this wrong. Doncic, Zion Williamson, and Jason Tatum have all signature sneakers with the Jordan brand. The players will attend events in Beijing and Shanghai as Nike looks to revitalize its business in China. And Expo says it's looking for a factory site in Europe as it seeks to mitigate the impact of planned EU import tariffs. The CEO, He Xiaopeng, told us exclusively that they're in the initial stages of selecting a site. He says the EV maker wants to build capacity in areas with relatively low labor risks. Xpeng's partnership with Volkswagen helped the company grow its gross margin in the second quarter from negative 3.9% a year ago.
Volkswagen has more strength on globalization, quality, manufacturing, and supply chains. We have more advantage on artificial intelligence, software, and electrical and electronic structure. So I hope we learn from Volkswagen's strength to make up our shortcomings.
Right. So, and speaking of big interviews coming up, there's the biggest one, arguably globally, in the next, 2 days or so. The boss at Nvidia, Jensen Huang, will be sitting down exclusively with Bloomberg Television after they report the second quarter results. Bloomberg Technology's special coverage begins 6:30 a.m. Thursday. If you're watching out of Hong Kong, that's about 6:30 in the evening, of course, if you're watching out of the East Coast. Plenty more ahead. This is Bloomberg.
Well, San Francisco Fed President Mary Daly says it's now appropriate for the Fed to begin easing policy. She told Bloomberg why it's hard to foresee anything preventing a rate cut next month.
Well, to my mind, we've been on this path of ready to adjust policy rates for several months. We just needed to get a little more confidence that inflation was truly on its path to 2%. And I wanted to see the labor market come into balance, but I think that's completely happened. And the risks to our goals are now balanced, and the time to adjust policy is upon us.
Is there anything that could derail a cut in September?
To my mind, that would be hard to imagine at this point. I do see that adjusting policy is appropriate. We don't want to get ourselves into a situation where we're keeping policy highly restrictive into a slowing economy. And remember, every time inflation comes down, the policy gets more restrictive. And I think that's a recipe, if you will, for over-tightening and injuring the labor market and growth.
Well, the chairman and basically the Open Market Committee said coming out of the meeting that the downside risks are greater to unemployment than to inflation. How big are the downside risks to employment right now?
Well, that's the very important question. And so we definitely have to keep that in mind because, as you know, the labor market, when it starts to adjust, often has adjusted abruptly and significantly. But right now, we don't see any signs of that. You look at initial claims for unemployment insurance. You look at early indications of layoffs. They're just not present. And so that's not giving us any signs that there's a deterioration. Importantly, as you know, the Reserve Bank president spent a considerable amount of time talking to contacts, businesses, workers. We're really not hearing signs that firms are poised for layoffs. What they are doing is managing headcount, making sure that they really want to refill a job before they do it. But at this point, I don't see any warning signs of weakness, but we want to make sure that we are adjusting policy as we go so that it's ready for the economy we have and for the economy we're likely to get, and ensure that we don't end up in that situation where we see real weakness.
Right, there we go. Mary Daly, their Fed president, San Francisco Fed president, speaking with Mike McKee, of course, there on the outlook for rates moving forward. It might have to do with the move we're seeing in the Japanese currency of late and the drop in the U.S. dollar against the Japanese currency. We are getting some comments coming through, and quite honestly, nothing groundbreaking coming through out of the finance minister, who is speaking in Tokyo. A couple of things here that they continue to watch the impact on the Japanese economy. Okay, that they're hoping for a debate on fiscal policy. And might be interesting, of course, as we move into perhaps the next risk to watch as it pertains to the Japanese macro story, because that LDP election that is set to happen, of course, this time next month is at about the same time as the BOJ meeting taking place. So watch out for that and mark your calendars now, I guess.
Yeah, so I mean, I guess they're commenting a little bit more on what's driving this yen strength of late. But what's really driving this HS Tech story is what we're hearing from Alibaba, JD.com, and the reaction to that.
Wow,
after we heard from PDD. That record drop in the ADRs overnight is certainly setting some jitters across the e-commerce space about just how strong or weak this consumption story is. Alibaba is down 4.6, JD.com is down some 5%. Trip, though, we talked about, that's the bright spot in this market today. A pretty massive beat when it comes to the earnings there. And PetroChina as well, up some 2%.
Yep, looking at the broader read on these cash markets, we're down to the Hang Seng Index. More coming up next. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI a half hour into the session. And as you can see, we are seeing a pretty sort of day here. Modestly lower, down by 0.5%. What to keep in mind is HS Tech. That's where we're seeing the biggest drag here today. The likes of Alibaba, JD falling here this morning on the back of what we heard from the PDD head talking about, it's inevitable that growth is going to start dwindling for them. What does that mean for the whole e-commerce space? You would think that maybe there's a sign that maybe Alibaba and JD are getting back a little bit more market share, and that's why you're hearing these Temu, the Temus and the Sheins are saying that. But then again, it's actually adding to more worries about this recovery story. Yeah,
of a shrinking overall pie, right? And I think the market reaction to what wasn't really something out of the blue, a 30% drop in the stock price, right? And that takes us also into how Nvidia and the chip stocks have been trading going into the earnings season, and you got to wonder whether the bar's too high. And again, Nvidia down 2%. Every single stock on the SOX index was down. You're looking at some of these chip stocks trading in the region here. Tokyo Electron's down about 2%. So this is partly the drag. You're also looking at drag from Chinese tech. We're looking at declines just about on the benchmark today. Let's flip the boards, please, and you have a sense of where we're trading there. You also have a sense of treasuries, 2 and 10, bottom of your screens. Still quite depressed, 381 on your 10-year yield. And Brent prices is the other big story we're tracking today, up nearly 8% over 3 days. We're paring back, and certainly the risks brewing, not just between Israel and Lebanon. Of course, the latest one was out of Libya, and force majeure there as far as some of the output and the exports are concerned. And so we are awash with risks, and certainly when you look at these markets, it doesn't seem we're priced for a slowdown when you look at stocks, but when you look at bonds and gold, it seems like we are. Anyway, we can get to that head scratcher a bit later on. But to the point we were making earlier on Baba and some of these tech plays here. Yeah, I mean, just take a look at what they're doing here right now, and they're really mirroring what we saw with the ADRs overnight. But it's really the left panel, right? PDD Holdings, there you go, dropping some 29%, the biggest drop on record. Take a look at Colin Huang, the PDD founder's fortunes. His #1 richest man in China ranking, I think, lasted only, 2 weeks to talk about? Now I believe he's like 4th right now. So just one day, the loss of fortunes was that much. And so you take a look at that, and really you're seeing the likes of JD.com down some 4 to 5% here right now. So it really was about what we heard from Temu's owner, warning of slower revenue growth. Let's bring in Catherine Lim, our Bloomberg Intelligence senior analyst. She joins us from Singapore. I mean, the drop was dramatic. Was it warranted, you think, Catherine?
Right. Do you know what? If we take a step back, The company missed revenues by 3% in second quarter and then had an excellent margins rebound, in the second quarter that was actually up 12% above what people were looking at, for the operating income. So it wasn't that bad a set of results, except that, it is the guidance on top of what we have actually seen, on the company, whereby we're seeing increased scrutiny from a regulatory standpoint for Temu as the company expands overseas, as well as Shein tussles with, Temu on certain patents, rights, etc. I think that's where the bulk of the uncertainty is coming from for PDD.
Okay, so how would you explain the market reaction, though? Why focus on the short term when maybe the medium-term story isn't as bad?
Well, now, clearly there is a question mark to whether, we will get into a worst-case scenarios of any regulatory penalties imposed on Chinese-backed platforms like Temu as regulations changes. And, we are seeing changes to which, the cross-border e-commerce platforms are selling into overseas markets as well. So, that is where the uncertainty is coming from for companies like PDD.
What does this mean for Alibaba? Does this actually mean that they've made an impact in China and overseas, and we expect to see more positive news from the company?
Right, that's a good question, Yvonne. I guess, definitely Alibaba is making a comeback in China. But, whether they will be able to actually better PDD in the environment whereby, overall sentiment it slows, that remains to be seen. Now, Alibaba is also investing more into its overseas business, hence the losses that we've seen for AIDC that could potentially widen over the next couple of quarters. So I would say that, they are pretty much in the same boat as PDD.
Okay, Catherine Lim in Singapore for us, our senior analyst, giving us their initial take on this massive slump, of course, in PDD and the guidance coming out of the company. Now, it wasn't just the stock price, of course, and of course the founder, Colin Huang, also took a bit of a hit, as Yvonne was pointing out earlier on. Before the drop in the stock, he was effectively a gold medalist on the rich list, and now he's barely made bronze. He's now number 4. As you can see on your screens, just ahead of that's Jack Ma, and okay, I'm wearing my glasses, but clearly I'm not. Zhong Shanshan is number 1, Ma Huateng with Tencent, of course, and Zhang Yiming is number 3. Number 4, of course, is Colin Huang, who took a big beating overnight in terms of net worth.
Yep, tumbling by $14 billion or so, the biggest one-day loss ever. Let's bring in John Woods, Asia CIO at Lombard Odier. Tell us a little bit more about the whole China story. It seems like there's still a lot of questions on why foreign investors should come back into this market. And I think this is a clear example of why not, maybe.
Well, I suspect that the low-hanging fruit, the easy money, is clearly a thing of the past now. And the macro backdrop to a positive or supportive outlook for corporate revenues is clearly under pressure, as we've seen just in the last few days or so. I would hope, actually, that accelerated monetary easing will provide a little bit of inflation for these margins, these corporate margins, which clearly are under pressure, clearly being subject to compression, and actually a little bit of inflation, I think, will take the pressure off that. But overwhelmingly, I think now this investment story is shifting to a stock pickers market. There are some 5,500 listed companies in China, and the days of purchasing a simple sector-based or index-based ETF clearly are gone. We now have to roll up our sleeves and start digging into the equivalents of their Ks and Qs to look for value. And I'm pretty sure that in this large universe of names, there will be as many diamonds as there are dogs, if you don't mind me my inelegant phrase. But clearly, this is a bottom-up stock pickers market. I think there's value, but it's going to be hard or harder to find.
That reality might also mean that the institutional money, the pension money that we were waiting to come back in, the incremental buyer, do they remain on the sidelines while it remains just a tactical trade, while it remains a stock picker's market, in your view?
A stock picker's market, David, as well you know, is both risky and expensive. It costs a lot of money to hire a large cohort of single stock equity analysts to identify value. And of course, then when you put more eggs in a single basket, maybe 3, 4, 5, 6 stocks that you expect to outperform, the risks are substantially higher than an ETF, which essentially balances and spreads your risk over a wide number of names. And you've seen the flows as well as I have. The institutional money, the foreign money, is very much on the sidelines right now. And I think this is largely driven, as we heard from your analyst previously, by policy risk. We just simply do not know what possible policy is likely to be announced, what it will contain, who it will say, and the impact subsequently on particular sectors and particular stocks. So this is something I think which is really keeping investors on the sideline for the time being.
I mean, in the same way that inflation in the U.S. was a good gauge of margins, and when we had inflation in the U.S., the market actually did quite well. Do you think that's a good leading indicator for Chinese equity markets? If and when inflation comes back, that's the time to get back in?
I mean, it's I guess it's a tailwind. It's certainly a tailwind if we start to see a little bit more consumption or inflation driven by consumption, retail spending, supporting corporate revenues and ultimately earnings, and clearly that is a positive thing. But the backdrop around particularly the property sector is overwhelming right now, and until we get some policy support from government relating to monetary easing and or additional further meaningful stimulus towards the property sector, I think the equity markets remain range bound.
All right, John Woods, he's staying with us from Lombard Odier, the Asia CIO. Coming up, Canada takes aim at China-made EVs and steel with tariffs of up to 100%. We have details coming up next. This is Bloomberg.
Well, to my mind, we've been on this path of ready to adjust policy rates for several months. We just needed to get a little more confidence that inflation was truly on its path to 2%. And I wanted to see the labor market come into balance, but I think that's completely happened. And the risks to our goals are now balanced, and the time to adjust policy is upon us.
Mary Daly there, the San Francisco Fed president, agreeing with Jake Powell that it is time to cut interest rates. John Woods is still with us, Ernst Setz, Asia CIO at Lombard Odier. So September seems to be a done deal. What are we going to obsess over now?
I think the Labour report for August, just before the FOMC meeting in September, I think the big focus will be on the comparison with the July numbers. My sense is that actually the underlying growth in the economy still has some momentum, and August will be a little bit better than perhaps the market's anticipating. If it's worse, then I think we could get 50 basis points from the Fed. My sense is, though, and as a house view at Lombard Odier, we're tilting much more towards a slightly more sanguine outlook. So our view is 25 basis points for September, subsequently 25 in November, and 25 also in December as well.
Yeah, I'm just looking at some of your conviction calls, your neutral fixed income, your neutral equities, your neutral gold with a modest overweight in cash. You're sort of leaning against this risk rally that we're seeing right now.
We're letting our strategic asset allocation drive returns right now. But you raise an important point because, we are concerned about complacency in the market right here, right now. We discussed previously, David, didn't we, that the MSCI World just made a fresh high overnight. The Dow Jones just made a fresh high overnight. Risk on does seem to be very much the state of play in the equity markets. But when I look at gold, when I look at dollar yen, when I look at 10-year bond yields, which have not budged barely from the sell-off we saw back in early August, they're telling an altogether different story. They're talking about safe haven. They're talking about this pivot from clearly inflation to the labour market and more broadly the growth trajectory. And our sense is that heading into this period, particularly with this geopolitical overlay, the uncertainty around Iran's response, behoves on us, frankly, a more strategic weight. And that's where we are comfortable right now, as I say, letting the strategic benchmark drive returns for the time being.
Okay, so if havens are expensive, risk assets are expensive, what is it, cash? Do we still talk about
Well, we have a modest overweight. I mean, 4.5% to 5% is clearly not a bad place to be when there are so many uncertainties around. Core government bond yields, we are neutral, but clearly offer some value given the recent rally we've seen in there. But I just think a diversified, balanced portfolio with a diversified mix of bonds and equities is clearly the right place to be. When we are beset with uncertainty, typically the smart portfolio manager will unwind their overweights, will unwind their underweights, will essentially revert to the strategic safety of a benchmark position, of a neutral position, and that's where we are right now.
How important are these Nvidia earnings? I mean, I know you can't talk specifically about the stock, but is this more important than what the Fed says and what the Fed is going to do in the next few weeks or months?
You know, I excluded the performance of NASDAQ from these equity markets that have been posting fresh highs of late. I should have said that the S&P is just a hair's breadth from a fresh high as well. That's clearly not the case with the NASDAQ. In fact, if you look at the NASDAQ, it does seem, I'm not saying rolling over, but it does seem to be stabilizing at these levels. And I think, again, this speaks to the shift from growth to value. This shift from, well, if you will, inflation to growth concerns. And to me, that actually echoes amongst the tech performance that we've seen, for example, in China as well, that there's probably a thematic view that we can take. But one thing I would notice is China also looking to constrict some of the rare earth inputs into the production of semiconductors. So I think, you know, that might actually, from a pure supply shock perspective, keep some upward pressure on prices for the time being.
Yeah, well, on the other note, on, you know, we're seeing, let's say, the equal-weighted S&P outperforming the NASDAQ. I mean, shouldn't that instill confidence that the equity market is broadening, beyond the 7 names that everyone loves to love and hate?
Well, I mean, over time, yes, absolutely, that's the case. The broader, the deeper, the more equitably balanced the index, the better it is, I think. But right now, of course, we have this legacy performance of the so-called Magnificent Seven, and you know, the expectations as embedded in price earnings multiples, I think, need to be balanced out, frankly, before we get to some sense of normality.
You mentioned you're watching dollar yen in particular.
Yeah.
What are you watching out for next, now that we've seen this carry trade unwind quite substantially?
Well, we heard Odier, didn't we, last Friday, speaking to the Diet, particularly focused on monetary policy. Our takeaway from that was that there's a growing likelihood of one more cut this year. You'll recall that the consensus or the narrative was actually him to step back from further tightening, given this extraordinary impact we had on the carry trade and the performance of dollar yen. But actually, from a real yield perspective, which actually are negative still in Japan, monetary policy, I think, is really still quite easy. So an additional cut, to me, makes sense from a house view perspective. We continue.
Additional cut. Okay.
Sorry.
Hike. We're about to rock global markets, John Woods.
The whole central bank narrative right now is Japan is the one standing out by itself. Actually, we would fully expect to see over the next 12 months dollar yen ticking lower to about 135, 10% or so, 8% to 10% from current levels, largely due to this tweaking of monetary policy and the tightening. Not the easing that I'm talking about.
We had a guess, I think it was 1 or 2 weeks back, that the view of us effectively, the Japanese bull market is over because the Japanese equity play was a pure currency play.
Yeah.
Would you agree with that?
No, I wouldn't. I actually feel now that the consumption story in Japan is really driving sentiment and earnings in Japan. You'll recall 10, 20, 30 years ago, the Japanese market could perform strongly with a strong yen. It's only recently we had this reverse, this sort of 180 flip where it was decided a weak yen was required and necessary. But if you recall, David, between 21, 22, 23, the topics barely moved. It was very tightly range trading, and we saw yen go from sort of 100 to 170. So clearly there's a breaking down of that relationship. And as a declining population puts upward pressure on wages growth, as consumption starts to pick up and accelerate, corporate earnings will improve, and my sense is the the topics and the equity market broadly will continue to perform.
You're focusing on the small and mid-cap style sort of equities.
That's
the next phase, you think, in Japan?
Yeah, that's actually a valuation call. I fully appreciate that the rally that we've seen in the large caps is approaching time for some sort of consolidation. But for us, it's very much a story of maybe you'd call them second and third tier names, which are driving earnings and are much cheaper than the blue chips.
We touched on it, but I think we haven't really laid out the thinking. So what are the key risks then to watch? If it's not inflation, is it a slowdown? Is it geopolitics?
At an economic level, it's growth. We're looking very closely now from a house view perspective at some of these leading indicators, the forward-looking sort of PMI services type indicators for a sense of direction on the growth trajectory. To me, that is the big risk, right? I mean, as a shop, we're very firmly in the soft landing camp. There's nothing from the data which would change that view from us right here, right now. But clearly, we need to keep a close weather eye out on that forward-looking data. And also the geopolitics, the politics and the geopolitics. It's our view that, for example, albeit both candidates are neck and neck, for the Asia region, I suspect that a Harris administration would be a little more positive.
Okay.
For our markets, we wouldn't possibly have that tariff risk that could impact our expectations and our sentiment. And the immigration story, I think, is also supported from a lower inflation. And the geopolitics in the Middle East, something that is concerning us and we look at very closely and critically.
John, always great to have you. John Woods, their Asia CIO at Lombard Odier. And a reminder, of course, we've got a big interview coming up. Nvidia CEO Jensen Huang himself speaking exclusively to Bloomberg Television after their second quarter results drop. Bloomberg Technologies special coverage begins at 6:30 a.m. Thursday in Hong Kong. That's 6:30 Wednesday evening in New York. You want to wake up for this in Asia. Plenty more ahead. This is Bloomberg.
Right, welcome back. Let's get to some corporate stories right now. Some big movers on the back of some earnings and results. Trip.com is a really good example of this today. Shares are up, as you can see, taking off really 7%. That's after adjusted earnings for the second quarter actually beating average estimates from analysts here. Its revenue for the period actually jumping to $1.8 billion. That's up 14% year on year. The company's executive chairman says they saw continued growth driven by strong demand, especially for cross-border travel. Staying on earnings here, PetroChina seeing record earnings for the first half with net income coming in at almost $12.5 billion here, boosted by high drilling output and also strong oil prices. China's largest oil and gas driller says output rose to over 900 million barrels of oil equivalent in the period. Now, you have upstream activities helping offset a weaker fuel market as China's economy sputters. Okay, there's no real segue to this here. You might have seen news here of who hasn't been to Din Tai Fung, right? Of course, the chain is closing down quite a number of its locations in mainland China. I think it's over a dozen of its 30-plus stores. It's not pulling back completely, but, it's really taking a step back in terms of the presence there, and on the back of, I guess, macroeconomic concerns.
I mean, when you have all these local F&Bs, even the KFCs, the Yum Chinas of the world that are slashing prices on everything, fast food or the like, it's hard to kind of stay in this really competitive market here right now. When you take a look at Din Tai Fung, per capita expenditure per person is about 150 renminbi. That's about, what, $21 U.S.? That's according to dampen. That's quite expensive.
That's a lot, actually. That's a lot in China.
And so I think, it's almost inevitable that you're seeing this sort of closures. But, yeah, it just goes to show. I mean, you see the likes of Starbucks really trying to get a little bit more competitive in the coffee space as well. You're seeing the struggles, really, for a big name like Din Tai Fung, too.
I mean, it's showing up in, you don't have to look very far from all the earnings that are coming through, right? Whether the Chinese companies that are looking for ways to cut costs and protect that margin, or some of the big European names that are present in the consumption space in China, and also seeing a drag because of the China business as well. This might be related to that, but not completely. Of course, here in Hong Kong, we have a version of this.
Yeah.
Sort of the softness across the retail sector is really playing out substantially too.
Yeah, I think Price Right, that's a home store chain. Tom Lee Music is a musical instrument retailer. They're shutting some branches in Hong Kong as well. I think also this trend of everyone kind of going up north to China is really hurting the F&B sector here, and we're seeing that as well. Pastis, I'm sure many bankers have been there.
Yeah.
A popular French bistro.
It's pure in pastis, right?
Yeah.
It's pure in pastis. And
also, I think we learned a little bit, reports that they might be shutting down soon as well. But yes, certainly. We'll leave you more with what these stocks are doing. This is Bloomberg. All right, we're heading to that lunch break in Tokyo here right now, 11:29 for those who are watching. And, of course, we're seeing when it comes to these equity markets, there's a little bit of nerves heading into this Nvidia earnings report. But needless to say, we're seeing we're marginally declining for the Nikkei 225. In fact, the Topix is doing something a little bit more positive. We're upside about 1/3%. Dollar yen, there is a little bit of weakness there, 144.83. Not much movement on your JGBs. We did hear from the finance minister earlier talking about the recent changes and movement in the currency. And not too much, though. So they're going to continue to watch FS impact on the economy.
Yeah, and whether it's a net positive right now, they're also looking at perhaps going into the LDP elections and any sort of differences as it pertains to fiscal policy. If you missed our interview earlier on with John Wood, so he thinks while the currency might appreciate to 130, 135, that doesn't mean the bull market is over. Looking at the region, though, we're up down 0.4 to 1%. We're looking at tech stocks in particular, so Chinese tech because of the PDD story, and also the chip story from overnight. So we're still feeling the drag from both those really large parts of the market. In fact, just as we go into the Tokyo lunch break, there we go, right? Tokyo Electron, one of the biggest drags across the chip space, down 2.5% going into this lunch break. Okay, let's turn our attention now to tariffs, and what we heard from the Canadian Prime Minister Justin Trudeau has announced new tariffs on Chinese-made EVs, aluminum, and also steel, joining his Western allies in taking steps to protect domestic manufacturers.
We will be introducing a 100% tariff on Chinese-made electric vehicles and a 25% tariff on Chinese steel and aluminum. But actors like China have chosen to give themselves an unfair advantage in the global marketplace.
Okay, Min Min Lo is here with us on set, our China correspondent. And how extensive are these tariffs?
Yeah, so the 100% tariffs on EVs is coming on top of the existing around 6% tariffs on Chinese EVs. And it's targeting not just the fully electric vehicles, it also targets some types of hybrid vehicles as well as buses, delivery vans, trucks. And Canada is also looking to restrict the consumer incentives for EVs to those vehicles that are produced in countries that have a free trade agreement with Canada. And on top of that, on top of the steel and aluminum tariffs, Canada is opening up another 30-day consultation period to look into potential tariffs for other items, including solar products, critical minerals, battery parts, semiconductors. So pretty extensive, a potential wall of tariffs that are targeted at Chinese producers. And Justin Trudeau, his government is facing a lot of pressure from lobby groups, especially the automotive sector, calling for the government to protect Canadian jobs and wages, so much so that the government has entered into agreements to provide multi-billion-dollar subsidies to help build plants, battery and EV plants for the likes of not Tesla, but Stellantis, Honda, Volkswagen. So you can understand why China might see this as a form of double standard here. China hitting back, saying that this is a form of protectionist measures, that its own capacity in electric vehicles are coming from its domestic innovation rather than what the Canadian finance minister is saying, which is China's abysmal record on labor and environmental standards.
Yeah, and we heard the response from China saying, urging Canada to correct these wrong practices on EV tariffs. What impact will we likely see from some of these EV makers in China then?
Yeah, so last year China had exported about $1.6 billion worth of EVs to Canada, but most of that are Teslas that were made in Shanghai's Gigafactory. So what's going to happen is likely Tesla is going to shift its production back to America to export to Canada. As for the Chinese producers, they don't have a huge foothold in Canada for now. And if you take US as an example, those tariffs have pretty much wiped out any chances of Chinese producers from entering the market. So the same thing might happen for Canada. We know that BYD had specific plans to enter the Canadian market. Just in July, they had informed the Canadian government of their intention, trying to lobby officials to let them enter the market. But right now, the math doesn't look like it's going to be in BYD's favor. Remember, they had also entered into that agreement with Uber as well. 100,000 vehicles that they want to put on the ride-hailing platform, starting with the EU market and then expanding to other markets, including Canada as well. But right now, we know BYD has a foothold in Mexico. They're looking to invest in a plant there. Could that be the final gateway for Chinese producers to enter the American market? That is the big question here.
Jake Sullivan is headed to China. What are we expecting there?
Yeah, so it is his first trip to Beijing as the top national security aide, but also likely his last trip before the U.S. elections. And the U.S. officials have downplayed any sort of prospect for big outcomes from this trip. It is described as just basically part of a series of regular meetings between the two countries to upkeep communication, to make good on that pledge between President Xi and President Biden at the end of last year when they met on the sidelines of the APEC summit. So on the agenda is likely to be, China's backing of Russia in the Ukraine war. The U.S. have been accusing China of selling these dual-use equipments that could aid Russia in the battlefield. And then U.S. likely to reiterate its position on the South China Sea and Taiwan. And Taiwan is that key flashpoint that the Chinese ministry has raised that they want to talk about with Jake Sullivan. It's, the foundation of the U.S.-China relations. They have been upset by the increased military backing, weapons transfer that the U.S. is sending to Taiwan. And then, of course, those tariffs, the investment restrictions, sanctions that China is very opposed to as well. China has been calling on the U.S. to stop its so-called wrongful practices. It's the same phrase that China is using on Canada now as well on those tariffs.
Thank you, Min Lo, there, our China correspondent. And we did hear from XPeng themselves as well, saying that it is looking for a factory site in Europe as it seeks to mitigate the impact of planned EU import tariffs. CEO He Xiaopeng told us exclusively that they're in the initial stages of selecting a site. Now, he says the EV maker wants to build capacity in areas with relatively low labor risks. XPeng's partnership with Volkswagen helped the company grow its gross margin in the second quarter from negative nearly 4% a year ago.
Volkswagen has more strength on globalization, quality, manufacturing, and supply chains. We have more advantage on artificial intelligence, software, and electrical and electronic structure. So I hope we learn from Volkswagen's strength to make up our shortcomings.
Right. Just on earnings there, of course, the other big one that we're tracking today, we're looking at shares of BHP up 2% here, the world's biggest miner, seeing its full-year profit edge up about 2% as well here, in line with forecasts. But a company's warning, when you look at the near term here, of potential gyrations in the commodity markets and uncertainty there due to what's, I guess, the uneven recovery we are seeing in China. Our Bloomberg Intelligence analyst, Mohsen Crofts, joins us right now to talk us through this. And, we did see, Mohsen, attributable profit was down, underlying profit, though, up, slightly above consensus. Just take us through what do you think was behind this discrepancy between those two things?
So the underlying profit was up primarily as a result of a pretty good result around their copper production. So EBITDA rose 4% to 29 billion, around in line with consensus, and that was a result of, as I said, pretty good upgrade in the 9% growth in the copper production to 1.87 million tonnes. When you're looking at the statutory profit, that's primarily the result of a couple of major impairments. So firstly, of the Western Australian nickel project that was written down earlier in the year, and then also impairments from the Samarco dam failure. And so once you take those extraordinary items out, it ended up being quite a good result for BHP.
Yeah, especially when you take a look at revenue from iron ore, copper, that seemed to have increased, as you mentioned. What is the outlook then for commodity markets, Mohsen, and how is that likely going to affect the earnings?
Yeah, so if you think about BHP as an enterprise, it's about 2/3 of its EBITDA comes from the iron ore business, and then another quarter from copper. So extremely exposed to the industrial metals complex, and particularly, as we're seeing at the moment, the troubles that China's been having in its property markets. And so as the CEO mentioned in the reporting today, they are expecting some volatility, and we would agree particularly over the next 12 months, probably, there is likely to face pressure in both the iron ore markets and the copper markets as a combination of supply coming through and then also a slow to pick up demand, with the Chinese government not really committing either way to any strong infrastructure spending as they have in previous cycles.
Mohsen, thank you. Mohsen Crofts there, Bloomberg Intelligence analyst, joining us out of Sydney. And stick around for our conversation with the BHP CEO, Mike Henry, about the outlook and on those China concerns. That's coming at 11 a.m. Hong Kong time, 1 p.m. if you're joining out of Sydney. Also in the next hour, we're going to hear from the co-founder of Guzman y Gomez after the Aussie Mex fast food chain saw a surge in full-year profit, but the stock is down this morning, so 4% after the guidance did disappoint some investors out there.
Yeah, taco fall, if you got that joke. Okay. LG Electronics is considering an IPO for its India business to tap a booming stock market as it targets $75 billion annual revenue by 2030. Now, our co-anchor, of course, and our Asia Trade co-anchor, Sherry An, spoke exclusively in Seoul with the CEO to discuss the company's global outlook.
On top of our major market like North America, Europe, and Korea, we see a lot of potential, growth potential in other emerging markets like India and Latin America and Middle East. So let me take an example of an Indian market. In India, we boast #1 market share in every single product. So as you know, India is one of the fastest growing market in the world, and the India will be continue to be a key market for our growth. But it's not about just the product sales. We aim to be the national brand in India. So as a company who have grown and loved by Indian people, we understand we should grow with Indian people, providing the product and solution which will make eventually their life better. And for the IPO, yeah, I understand there's increased interest in Indian market among global investors. And
especially with Hyundai's successful Indian IPO as well.
Yeah, we follow all the IPO events of the companies. Yeah, it is yes, increased interest, but as of now, nothing is confirmed.
But it's being considered.
It is one of the many multiple options we can consider. Nothing is not yet confirmed.
Are there any other growth markets that you're targeting? You've mentioned India, you've mentioned Latin America, the Middle East as well. What do markets like China look like given the economic uncertainty there?
Chinese market is hyper competitive due to the multiple players in China. I think they are struggling with the shrinking demand in China. That made the competition even more severe. So for the time being, we do have some presence through the online businesses. We are in kind of status in wait and see for now.
That was the LG Electronics CEO William Cho speaking exclusively to Sherry An in Seoul. Still ahead, eyes on the skies will attract the growing presence of Chinese airlines on major routes as they brush past competitors to seize a lion's share of air traffic. We have details coming up next. This is Bloomberg.
Right, the biggest winner across the Asia-Pacific complex today, I think, is still Trip.com. It's certainly up there within the top three, up 9%. You're looking at the best day in nearly 2 years here for the company after just a blowout, in some ways a blowout set of earnings here, really coming in well above estimates here. And I guess goes to show that domestic travel is still something, as we were talking about earlier, with our Bloomberg Intelligence analyst, something that is still taking place amidst
cross-border travel too.
Cross-border travel, yes, coming in,
inbound and outbound. People are still willing to spend when they go overseas. Maybe not so much when it comes to flights, they said, but maybe for the overall experience.
Yeah,
still.
they're not eating though, is what they're saving on. Consumers are saving on some of the.
And they're saving on flights. That's what she said.
Yes, so they can spend more.
So they can spend more.
Or in hotels.
All right. What does that mean for Chinese airlines? That's certainly one thing we're asking, is because they seem to be elbowing their fellow rivals out of these major international routes. And that's after rapidly rebuilding their foreign networks from COVID-era lows. And that's really been fueled by a government eager to kickstart the economy and burnish Beijing's global standing.
Yeah, for more on this story, our aviation reporter Danny Lees here was with us on sets. How big of a market have they muscled back, Danny?
Yeah, this is like a $27 billion market that the international airlines, the Chinese carriers, are fighting for flights in and out of China. And so by the Chinese carriers taking a greater share, a dominant share, almost 2/3 of the marketplace, it's really them showing a sign of strength and a challenge, a retreat for the foreign carriers. And when you talk about how Chinese people spend, the Chinese carriers do ultimately price their tickets a lot lower. So it's good news for travelers ultimately, but does it say more about the health of the Chinese economy and the attraction that China has to the rest of the world? Because the Chinese airlines are almost becoming the last resort for connecting China and the world, because ultimately they have the advantage that foreign carriers don't have in terms of accessing Russian airspace and a whole host of things. And it's foreign carriers are more discouraged to fly these days.
Yeah, what are they saying particularly? I mean, they're obviously probably not happy about this.
Yeah, I mean, the foreign carriers have warned for a few years now that there is a big disadvantage for them having to fly longer. It's more expensive for them, and they can't compete in terms of the costs, and they can't compete on the airfares just because Chinese airlines are pricing their flights a lot lower. And when it comes to being pricing a lot lower, it distorts the marketplace overall. But clearly, Chinese airlines, who are growing bigger and more ambitious, and actually are some of the biggest in the world, they very much are at the top of the game at the moment.
All right, Danny, thank you, Daly, our aviation reporter there. In other corporate stories that we're watching this morning as well, Bloomberg has learned that Canadian retailer Couche-Tard could issue debt and tap its pension shareholders to help fund a proposed buyout of 7-Eleven owner Seven & I. Sources tell us a leveraged acquisition of the Japanese company would be feasible because of its strong cash flow. Seven & I has appointed independent outside directors to evaluate Couche-Tard's proposal. Edgar Bronfman Jr. is dropping out of a bidding war for Paramount Global. He submitted a $6 billion proposal for the entertainment firm last week, challenging an earlier offer from Skydance Media. Sources say Skydance accused Paramount of breaching the terms of their merger agreement by continuing to engage with another suitor.
Now, Nike's Jordan brand says it's actually bringing several of its top sponsored, one on your screens, NBA stars on a tour of China in a new push into a key growth market. So you have Luka, of course, on your screen, Zion Williamson, and also Jason Tatum. All have signed signature sneakers with the Jordan brand. Now, the players will attend events in Beijing and in Shanghai as Nike looks to revitalize its business there in mainland China. Plenty more ahead. This is Bloomberg. Right, let's talk about the Fed and what markets now deem as almost a guaranteed 25 basis point cuts. We now have the latest from the San Francisco Fed president says it's now appropriate, in fact, for the Fed to begin easing policy, echoing last week's comments out of Jay Powell at Jackson Hole. Mary Daly told us why it's hard to foresee anything, though, from preventing a rate cut next month.
Well, to my mind, we've been on this path of ready to adjust policy rates for several months. We just needed to get a little more confidence that inflation was truly on its path to 2%. And I wanted to see the labor market come into balance, but I think that's completely happened. And the risks to our goals are now balanced, and the time to adjust policy is upon us.
Is there anything that could derail a cut in September?
To my mind, that would be hard to imagine at this point. I do see that adjusting policy is appropriate. We don't want to get ourselves into a situation where we're keeping policy highly restrictive into a slowing economy. And remember, every time inflation comes down, the policy gets more restrictive. And I think that's a recipe, if you will, for over-tightening and injuring the labor market and growth.
Well, the chairman and basically the Open Market Committee said coming out of the meeting that the downside risks are greater to unemployment than to inflation. How big are the downside risks to employment right now?
Well, that's the very important question. And so we definitely have to keep that in mind because, as you know, the labor market, when it starts to adjust, often has adjusted abruptly and significantly. But right now, we don't see any signs of that. You look at initial claims for unemployment insurance. You look at early indications of layoffs. They're just not present. And so that's not giving us any signs that there's a deterioration. Importantly, as you know, the Reserve Bank president spent a considerable amount of time talking to contacts, businesses, workers. We're really not hearing signs that firms are poised for layoffs. What they are doing is managing headcount, making sure that they really want to refill a job before they do it. But at this point, I don't see any warning signs of weakness, but we want to make sure that we are adjusting policy as we go so that it's ready for the economy we have and for the economy we're likely to get, and ensure that we don't end up in that situation where we see real weakness.
San Francisco Fed President Mary Daly there speaking with Bloomberg's Mike McKee. Let's get to your cheddar brief here this morning as well. Look at what's making headlines in the national media. Now, state media outlets are striking a largely positive tone in their coverage of the visit by U.S. National Security Advisor Jake Sullivan. An editorial in the nationalist tabloid Global Times says that Beijing's invitation to Sullivan reflects a constructive attitude towards the relationship. However, it adds that there is a significant gap between Washington's actions and his stated desire to maintain stable ties. China is expected to bring up issues including Taiwan and tariffs with Sullivan, who is scheduled to meet with the Foreign Minister Wang Yi.
Meanwhile, state media are also reporting on Premier Li Qiang's call here for targeted policies for China's aging population. Li reportedly told a state council session that China should boost services and funding support for the elderly and expand its so-called silver economy. And the Securities Times is flagging plans by officials to encourage the entry of medium and longer-term funds into the market, citing unnamed market insiders here. The report says measures being prepared include improved accounting and taxation. It also says officials want to promote a virtuous cycle of long money and long investments in the market. Now, the paper also has an update on the mid-year dividend payments by Shanghai-listed firms. It says that more than 150 companies have disclosed dividends, with the expected payout reaching nearly 135 billion renminbi, or that's about 19 billion U.S. dollars. Right. Back to the other big story in markets right now is oil, and Goldman is out cutting their forecast for Brent to $77 from the previous forecast of 82. And as you can see, oil is pulling back after what was really quite a substantial increase over the last nearly 8% over the last 3 days or so.